Okay, on part 3, we are talking about ownership, the difference between sole ownership and the various types of concurrent ownership. When title to a property is held by a person, it does create an estate in severalty or sole ownership. So just remember that. Think that the ownership interest has severed or been cut from anybody else. And separate property, though, is the property that a spouse owns in the spouse's name only before a marriage. Therefore, the property acquired by one spouse during the marriage by inheritance or gift. And property acquired during the marriage, except by inheritance or gift, is often referred to as marital assets in Florida. For example, one spouse may purchase a property with her own savings and title the property in her name, but unless the couple, say, signed a prenuptial agreement, the property is legally a marital asset. And then if they later divorce, the courts maybe they will divide the marital property equitably according to the opinion of the judge. Now, if there are more than one owners, 2 or more owners of a property, this is called concurrent ownership. And there are 3 different types of concurrent ownership: tenancy in common, joint tenancy, and tenancy by the entireties. I've just got a little graphic here. This is a person who owns a property by himself. And when you go to own a property, you have to receive a deed. And this is usually done by an attorney or a title company, and at a time and a place. So this person has received a deed, and on a particular date, and that person owns the property 100%. And if that person should die, because there's no other owners, it can't go to them. It will only go according to what the will states of that dead person or any heirs that the court find. So that's severalty. One deed, one date, 100% ownership. Now, let's supposing this lady buys a property and then later on decides that she wants 2 other people to have ownership with her. This is a concurrent ownership. This is called tenancy in common because we can actually have 3 deeds at different times allocating each part of ownership to each of these owners. And it doesn't have to be equal shares. It could be, for instance, 30%, 20% and 50%. And once again, in this particular situation, when one of them dies, their share will go to whoever the will specifies. A similar but slightly different is, let's supposing these were, say, brothers and sisters, and they decided they wanted to buy a property, and when one of them dies, their share, that person's share, would go to the others. And therefore this is called joint ownership. In this particular case, it can only be done on one piece of paper, and it has to be done all at the same time, and their shares have got to be equal: 33 1/3, 33 1/3, 33 1/3. And when one of them dies, then that third will go to the other. And then when that one dies, then the rest of it will go to the sole owner. So that's based on survivorship. Regardless of what their will says, the share of the person who dies will go to the other owners. And then we have the married couple, who is similar to joint, but is a married couple. Obviously, it can only be 2 people, and the law presumes that a married couple is one entity. So once again, it'll have to be on one deed, and this is called estate by the entireties. One deed, one date, and both of them own everything 100%. And once again, that's survivorship. So that's how we base that. If we look at the book, you'll see this particular diagram. And the only thing we haven't mentioned here, on all of the concurrent ownerships, they all have undivided possession. Now that means that it's not like, in tenants in common, I own the top floor, you own the middle floor, and the other person owns the bottom floor. It means they have whatever their share is of the whole building. We'll go through that again. Here's another quick example. We've got Tom, Dick and Harry, joint tenancy, 3 brothers, all decided, triplets, that they wanted to buy a property. When one dies, okay, let's get them over there. And when one dies, Harry dies, then Harry's share will go to Tom and Dick, 50-50. And then if Dick should die, then his share will go to Tom, and Tom becomes owner in severalty 100%. Let's go back to the beginning, and let's supposing, for instance, that Harry wanted to sell his share to Mary. Well, Harry can do that, and Mary's going to pay him whatever the 33 1/3% is worth. But now Mary is not a joint tenant with the other two. Mary is a common tenant with these two who are still joint with each other. Therefore, if Dick or Tom dies, then his share will go to the other, whereas if Mary dies, it will go to whoever is in her will. If Dick dies, then Tom will become 66% owner, and then she will own this property in common with Mary. If Mary wanted to come inside that circle and become joint owner with these two or one, then they would have to go down and get it redeeded and retitled in their names as joint owners. All right, let's just go on to the co-ops, condominiums and time sharing. We're talking here about cooperatives. This can be a multifamily building or a lump of land owned by a corporation, and the owners purchase shares of stock, and then the stock ownership entitles the purchaser to a proprietary lease to and right to occupy a unit or a mobile home pad. Property taxes are assessed on each unit, and each unit has a unique parcel number, and you can also deduct these taxes from your mortgage interest from your annual income tax return. This is very similar to a single family home. And shareholders will pay a pro rata share of the common area, property taxes on the common areas, and also the corporation will pay the tax bill which they contribute to, and also shareholders pay maintenance and service fee to the corporation. This is a typical example of the co-op we have in Florida. A lot of trailers here. What it is, the co-op owns all the land, and buying a share of the co-op entitles one shareholder to use one part of this land, i.e. the sort of concrete pad which has been allocated for a particular number there. The mobile homes will be personal property. They will have trailer VIN numbers, but so they won't be regarded as real property, but the proprietary lease on the parcel that they're using will be given a parcel number, and that will be regarded as real property. Here's another example of a possible co-op, apartments which were sold off and turned into a co-op as opposed to condominiums. But you don't get a deed. There's no deed. You get a proprietary lease through a purchase of the shares of the stock. Okay, do remember that. No deed. But when you do buy into a co-op, either a new one or from a resale, they have to give you the cooperative documents, and the potential buyer's got 15 days from a new developer to look at these and cancel the contract. If it's from a resale, then that person's got 3 business days. So don't get confused with 15 calendar days and 3 business days. Condominiums. Once again, condominiums is not so much what they look like, but what sort of ownership they have. And essentially, they can be single-family homes. They can be what we're looking at in the picture there, or even a multi-story condominium block. But once again, very similar to a single-family home. In this particular case, each condo unit is owned fee simple. Plus, you have an undivided, that means a fractional share of everything of the common elements. And the deed conveys the ownership, and common elements are legally attached to each unit and transfer with the unit. Maybe condominiums on the waterfront actually come with a boat dock, and that will be legally attached to the condominium. And they pay property taxes, and each one has a parcel number, and ownership is granted by a deed. The following documents must be given to a buyer of a condo. You have to give them a declaration of a condominium, articles of incorporation, bylaws, and a frequently asked question sheet. That's for all sales. If it is a developer sale, then in addition to those 4, you have to give a prospectus if there's more than 20 units and an estimated operating budget. If it's from a resale, I beg your pardon, the purchaser has got 15 calendar days to cancel after signing the contract. The clock does not begin until the buyer also receives the condo documents. 15 days. If it's resale from an owner, then we still have to have those 4 documents, plus the most recent year-end financial information and rules of the association and the governance form. They've got 3 business days to cancel. We talk also about timeshare. Timeshare is like a condominium, but instead of just having one owner forever and ever, it has usually 52 owners forever and ever. In other words, the ownership is divided into time segments, which is usually a week, so you have 52 owners. Once again, you usually get a deed. There is a parcel number. You can actually deduct your mortgage interest and taxes, and that is how a condominium, a timeshare works. Few strange rules about it. Real estate license is required if you're going to sell another's timeshare for compensation. If you work for the developer as a salary, then you don't need a license. And of course, owners can sell their own timeshares. A strange law here: it is illegal to collect an advance fee for listing a timeshare. We don't normally do that, but there was a case where timeshare agents were charging in advance for the listing and not being able to sell the timeshare. They kept the money. And its required disclosure has got to include some wordage which tells you all about the commission's terms, broker services, and termination and listing extension rights, and if there's any judgment or litigation against the broker selling the timeshare. Timeshare sale contract must also contain wordage which include the current year's timeshare assessment, and if property taxes are not included, how much that property assessment is, and also a property tax assessment is, and the form of ownership, and who is looking after it, who's managing it, and the terms for closing and cost, and any mandatory exchange program. We cover that a little bit more. Regardless of whether it's from a buyer, resale buyer or developer, the buyer has got the right to cancel within 10 days of signing a contract or receipt of the public offering statement. New timeshares from the developer, resale timeshares are covered by this 10 days. That's calendar days. If you don't see business, then it's calendar days. There are 2 different types of share ownership. The most common timeshare ownership, the most common is interval ownership, which is sometimes called fee simple ownership. You have a fractional interest transfer by deed. And then you have basically a long-term lease. It's the right to use. Usage of a timeshare is limited to a certain number of years. Ownership of timeshare remains with the developer. And this is usually 30 or 40 years. And you can sell on that particular lease that you have. But it's very unusual to see these. And that's really it there on Unit 8. So thanks very much for listening, and I'll see you next time.